2024 has been a rather eventful year as we transition from an environment of high for longer to monetary policy easing. Markets were also constantly engaged in whether there is any economic soft landing or hard landing, only to find out there was not much of a landing. And then not too long ago, we had the US elections, and it does appear that the incoming US administration led by Trump promises more surprises. The year of 2025 could potentially be a highly volatile year characterized by the 3 Ps, namely policy normalization in terms of monetary policy, whereby most central banks are cutting rates and some may go faster or slower while another handful are raising rates. The second P is politics or geopolitics, whereby there remain political uncertainties in Germany and France and even South Korea. In the geopolitics space, armed conflicts in Russia-Ukraine as well as Israel-Hamas are still ongoing. Spikes in tensions can lead to demand for safe haven proxies. Okay, the third P is protectionism. Trump's threat on tariff is clearly one of the biggest risks that markets are focusing on, as it can undermine global trade, global growth, and market sentiments and pose risks of inflation for US. Now, at this point, it remains uncertain if pre-election threats or promises become reality when it comes to policy making over the tariffs intended as bargaining chips to unlock greater policy agenda. The timing, the magnitude, and the scope of tariff implementation in itself is already an uncertainty. We may need to observe a little further to get more clarity on policies, and more importantly, we may have to be prepared for a wide range of plausible outcomes. Well, coming to FX outlook for the dollar, the risks are broadly skewed to the upside, but we do not rule out a slight pullback in the first quarter of 2025 as Fed cuts remains underway and that dollar starts off high, pricing in most of the risks out there. Now, over the course of second quarter to second half of 2025, the dollar risks are skewed to the upside as we take into consideration the risk of tariff implementation and that Fed could potentially slow its rate cut cycle. Our medium-term view still expects the dollar to trend lower. Dollar's overvaluation alongside rising debts, twin deficits of fiscal and current accounts are some drivers that should weigh on the dollar. For euro, the risks are skewed towards depreciation pressure. Growth momentum in the euro area is already slowing, adding to expectations that the ECB may need to cut more or cut deeper to support growth. Elsewhere, Trump's universal tariffs of up to 20% can potentially hurt Europe's exports and growth if they are implemented. Now, US is Europe's top export destination, and the US, or rather the EU, has a trade surplus with the US. Overall, concerns of political uncertainty in France, Germany, softer growth momentum in the euro area, and potential widening of the euro to treasury yield differentials are some of the factors that may weigh on the euro. But over the medium term, euro can revert to trend higher when growth stabilizes, while political and policy uncertainties find some clarity. Moving to yen, our bias is for dollar yen to trend lower, premised on Fed cut cycle, while the BOJ has room to pursue policy normalization. Additionally, protectionism threats, geopolitical uncertainties are other factors that can also be supportive of safe haven proxy, such as the Japanese yen. Nonetheless, any slowdown in the pace of policy normalization, be it the Fed or the BOJ, would mean that dollar yen's direction of travel may be bumpy or face intermittent upward pressure. For Asian FX, the fog of tariffs weigh on sentiments. Now, the currencies that are highly sensitive to market developments, such as a weaker RMB or Fed slowing rate cuts, will come under more pressure. So the likes of Korean won, Thai baht are amongst the Asian currencies that may remain weak going into 2025. For the renminbi, depreciation may be the path of least resistance. The RMB remains sluggish amid expectations for further rate cuts, while economic recovery in China remains uneven. US tariffs can hurt renminbi, but PBOC may also be inclined to restrain the RMB from excessive weakening in the interim until the tariffs hit. There may be other stimulus support measures to support the domestic economy, but these are at best mitigating factors only. A more sustainable recovery in the renminbi requires a confidence to be repaired, economic recovery to gain better momentum, and for the dollar to turn lower. For the Singapore dollar, the currency has enjoyed relative resilience on a trade-weighted terms over the past few years amid MAS on appreciation policy stance. But as core CPI in Singapore eases, there may be room for the MAS to ease policy stance slightly at some point in 2025. Now, this would imply that some of the strength that we've seen in the Singapore dollar could potentially fade in 2025. But so long MAS policy band doesn't revert to neutral, the Singapore dollar could still retain that relative resilience as it also holds onto its safe haven status in the region in the event there is any trade war or risk-off scenario. For Malaysian ringgit, domestic fundamentals are sound, supported by foreign inflows, domestic stability, and robust macroeconomics. But it can also be vulnerable to external developments. US tariffs can undermine global trade, growth, and broader market sentiments. RMB sensitive and growth sensitive currencies such as the ringgit may also be impacted. Now, a return of this US exceptionalism or inflation in the US will result in US or the Fed slowing its pace of rate cuts. Now, this can widen Treasury to MGS yield differentials, in turn weighing on the ringgit. For the Indonesian rupiah, its lower sensitivity to RMB may help to anchor a bit of a stability for the IDR amongst other ASEAN peers that are more sensitive to the renminbi and open trade. Now, that said, IDR is not immune to external developments. A stronger dollar and/or foreign portfolio outflows can also undermine the Indonesian rupiah.